In the life cycle of a successful service business, there is a distinct phase where revenue climbs past $5 million and growth entirely stalls. The operation reaches maximum capacity, and the primary bottleneck becomes the founder's mental load. We can see this paradox clearly when we compare financials to daily operations. On the left, the P&L shows steady, highly profitable revenue growth. But on the right, the founder's calendar reveals overlapping commitments and direct delivery management. Traditionally, operators view high utilization rates, often hitting 85%, as the ultimate scoreboard. It suggests a highly efficient ship. But to a private equity underwriter, that metric means something entirely different. A completely full calendar isn't proof of efficiency. It is a massive systemic risk, especially if delivery relies on the founder. Institutional buyers don't buy historical busyness or full calendars. They purchase scalable capacity. They underwrite the platform's ability to handle aggressive future growth. To evaluate that ability, private equity firms break the data into three components. First, they measure utilization as the raw input, how much capacity you consume. They evaluate realization as the translation layer, how efficiently that time converts into collected revenue. And finally, they deeply analyze forward capacity as the true output. A firm with high margins and high utilization will consistently fail to secure a premium valuation multiple until it can prove its busyness translates into repeatable throughput. Without that proof, the business cannot be sold at scale. The primary obstacle to that scalable throughput is what M&A advisors call the phantom billable. This is top-line revenue that looks perfectly clean on a financial spreadsheet, but is structurally flawed at the operational level. On the surface, we have a pristine invoice for $250,000. But fulfilling that work inherently relies on the founder intervening directly. The revenue is propped up by hidden structural dependencies, rewriting scopes, rescuing technical problems, or managing client crises. During diligence, buyers rigorously reconcile your utilization against actual delivery outcomes. They actively look for these hidden interventions, and when they find them, the supposed value of that revenue collapses. This diligence exposes the critical gap between utilization and realization. Utilization only measures the time your team spent working. Realization measures the time that actually translates into collected revenue, strictly accounting for scope drift, write-downs, and rework. If buyers discover that your realization rates are only sustained through constant founder heroics, they will aggressively discount your valuation. Keeping your utilization metrics high by personally patching delivery gaps does not prove scalability, it proves liability. Consider the case of a specialized IT consultancy in Silicon Valley. The firm generated $7 million in annual revenue, with strong margins, yet its attempt to sell a majority stake to private equity stalled completely at the diligence table. The buyer's pushback was direct. The firm operated entirely as a custom job shop. Every enterprise client required a bespoke strategy, and the founder personally designed every single one. This network graph highlights the exact operational bottleneck that halted the deal. Numerous incoming client pathways all route directly into a single, highly congested central node, the founder's personal execution. Institutional buyers are perfectly comfortable with hard work. What they fear is non-transferable work. To salvage the deal, the advisory team implemented a 60-day turnaround strategy. They mapped and productized the top 3 service offerings. The founder's bottleneck was replaced with 3 distinct, standardized pathway nodes. They enforced strict standard operating procedures for the secondary management tier, allowing delivery to run smoothly and completely bypass the founder. Equally critical was standardizing the statements of work. By moving away from custom scoping and project drift, the firm eliminated the silent margin leaks that previously required the founder's intervention to fix. Within 2 months, the hours the founder was required to dedicate to delivery dropped by roughly 60%. The primary diligence risk was eliminated. By repositioning from a bespoke boutique agency into a highly scalable platform, the firm returned to market, successfully attracting a strategic buyer and securing both a premium valuation and a meaningful equity rollover. Proving this kind of scalability requires entirely abandoning historic utilization reporting. Buyers are underwriting the next 3 years, so your metrics must look forward. The solution is forward capacity modeling, a strict mathematical proof of your firm's scalable throughput. This formula is the exact baseline underwriters use to calculate raw team capacity. If we apply this to a 10-person delivery team working a standard quarter and deduct a 20% non-billable overhead requirement with a 75% utilization target, we calculate a firm capacity of 3,120 billable hours. Finally, you multiply those pure billable hours by your expected realized rate, the actual dollar amount you collect after rework. The result is a highly defensible revenue ceiling. This output provides buyers with hard proof of exactly how much revenue the firm can fulfill at its current overhead tier, completely independent of the founder's direct involvement. Implementing this model before going to market forces you to have the right operational conversations. It clarifies when to trigger hiring, where to install quality assurance gates, and how to structure escalation paths. It is your ultimate defense against valuation haircuts, effectively answering the buyer's most critical question: what breaks first if we inject capital and increase deal flow by 30%? Transitioning from a high-stress consultancy to an institutional-grade asset requires aligning your operations with the metrics buyers actually value. This relies on 3 specific levers. First, you must aggressively quantify and then reduce the percentage of revenue attached directly to the founder's technical execution. Second, you must standardize your statements of work into modular tiers, empowering junior staff to price and deliver without variance. And third, you must replace lagging utilization metrics with forward capacity modeling to prove the repeatability of your economics. When these 3 levers align, the narrative in your diligence data room shifts entirely. You are no longer telling buyers that you are busy. You are proving that you are a repeatable growth engine. Buyers will rigorously sample your previous contracts and interview your mid-level managers to ensure the scalability exists in daily practice, not just in theory. You already mastered the grind required to build a profitable business. To secure a premium exit, you must now engineer a machine that runs without you.